Good morning, everyone. Marty Mazzora, 20th of February 2019. Quick chart update for you. Going to stick with the chart we've been going over for several weeks now. It's the S&P 500 one-year daily chart, and as you can see here with yesterday's bar, we are now continuing our march above the 200-day moving average, which, as we discussed up in here, could be a source of resistance, was for several days and came back through that, moved 2 or 3 days right at that level, and now have spent a couple days moving above it. Listening to, just reading some headlines from some technicians, it seems like there's some growing skepticism about the sustainability of this move. Very popular technical analyst over the weekend pointed parallels to 2015, and I'll show those to you here in a second. I just noticed a headline this morning saying we're starting to see a little choppiness in here that could suggest that this is nearing an end and that we may come back and test some lower levels. Of course, all of that is very much within the realm of possibilities. Markets can do virtually anything, and they can surprise the best of technicians and analysts and fundamental traders and investors and so on. I personally am much more constructive, all things being equal, on this move above the 200-day moving average than I was back in here. Some of you may recall those videos where I was showing technical indications that this probably wasn't going to hold, and indeed it didn't. This looked a little better until we got some very concerning news around China-US trade talks. A big one in here was the arrest of the Huawei CFO in Canada at the behest of the U.S. Department of Justice, and that story is still unfolding, although both sides have done a pretty good job of separating that from the trade talks. At least that's how it looks on the surface. The technical indications, the internals, some of the indicators that show us the support underneath a given market move are actually quite encouraging at this point. And I want to emphasize all things being equal, meaning the current trend in information around the U.S.-China trade talks, if it is to remain positive and we ultimately get to a resolution sometime soon, I think this market can go higher. And I think that's what traders are anticipating when I look under the surface. And this morning, we're just going to focus on that very simple on-balance volume. Remember, we accumulate the number of shares in the direction of the move. So when the market is up and you get a big move in this line, that means there was a lot of volume during that upturn. When you have a down market and you have a big down move in this indicator, that suggests there was a lot of distribution, a lot of selling on the down days. You can see in here, big move on the down days, small move on the up days, not much conviction on the part of buyers, but big conviction on the part of sellers. In here, very steady move upward and on balance volume, consistent with the trend here in price. Back in here where we had some concerns, as you can see, this first failed attempt at the 200-day had no confirmation in here with on-balance volume. Things began to look better up in here and here, but things ultimately fell apart. Once they fell apart in the big way. When we've had resistance up in here, we didn't have big, massive selling. We had decent volume, but not big volume. We definitely had bigger volume to the upside. Hence, this trend continues to move. So again, very different look in terms of the on-balance volume back in here. Very constructive look in here. This would be accumulation by definition. This would be uncertainty, ultimately distribution. Folks looking for opportunities to sell on the up days, folks looking for opportunities to buy on down days. Now, going back to that 2015 period that the analysts referenced this weekend, showing us coming off of a pretty steep correction off the bottom here, the second bottom, if you will, and then testing that 200-day moving average, and this is what she was talking about. We could very easily fail and ultimately go down even below the previous lows if this were a current chart. So here we are back in 2015, coming above the 200-day moving average, testing it, moving higher, and today we'd be in here. But look at the look on on-balance volume, quite different than what I just showed you. And then we came back and tested it, as you can see clearly, traders were taking the opportunities on the up days to really sell this market. So we had absolute distribution during this whole period that she was referencing. So again, folks, much more constructive look today in terms of what volume says about the state of the current rally. It looks sustainable to me. Makes sense when I look at sentiment indicators and cash on the sidelines and so forth. I see more potential fuel than I saw back in here. I will say again, though, that this could tip quite easily on any negative commentary coming from the US-China trade talks, which are going on as I speak. Other items to pay attention to: the minutes from the last Fed meeting are being released this week. The market is very interested to see what the members had to say, particularly about the balance sheet that they're rolling off to the tune of roughly $50 billion each month. The market seems to have some concern about the tightening effect of that action on monetary conditions. Jerome Powell seemed more flexible in his last commentary on that, so we'll see if that's confirmed by the minutes. Brexit negotiations are going on. Theresa May is in discussions with the European Union this week to see if they can give a little bit. Sounds like they're establishing a pretty hard line themselves. So Brexit may come down to the wire right now. That doesn't seem to be moving markets to the extent that it was a few weeks ago. And I just think that's because all eyes are on this US-China trade talks. As I've been hinting on the blog, once we get through that, I'm going to be very interested to see how this administration approaches Europe on trade. On Saturday, the president received a report from the potential security risk of importing cars from places like Japan and Germany. I expressed my opinion on that over the weekend. I do believe that if we go there, it will be very ugly instantaneously for the market. I hope that the powers that be understand that the market is basically just reflecting economic reality, that there will be no continued global expansion under a global trade war scenario. In my view, that is unequivocal. So hopefully we won't go there. Thank you as always, folks, for watching and listening, and I'll talk to you again very soon. Take care. Bye-bye.